Welcome, everybody. Thank you for waiting for us. We had a couple minutes to get ourselves straightened out here, but we're back for another financial model teardown with the team from Gust and Forecastr. Today, we are joined by Logan from Forecastr. We don't have Steven, but I am going to play armchair financial analyst as well and provide some of the back and forth for him. We have two great founders today. We might have a third. We'll see if they show up halfway through, but we have Doug Grant and Tracy Kimball. They are brave souls who are going to volunteer to share their financial model of their startups and allow us to tear it down and to suggest reviews, feedback. We really feel like these events complement the other programming we do around fundraising and financials because the abstract concepts really come home to roost when you actually have an Excel document open in front of you or a Forecastr account, should you be so lucky. And it's a great way to share all those questions about different kinds of business models. How would this apply to a physical product company? How would this work if I'm a B2B marketplace, and et cetera? Really learning by doing, sharing, and also connecting founders in our cool kind of joined communities to learn more about what people are doing in the space. So we have two really cool companies, possibly three, and they're very, very different. So this is going to be a fun one. We're going to do Doug's up first, and then we'll go through Tracy. Think about maybe 20 minutes, 25. There'll be time for questions. Please use the Q&A and chat throughout if you have anything relevant. As always, I'll interrupt people if there's something super relevant, or we'll save some time at the end. We are time gapped today, so we're going to start dead at 4 Eastern. But let's get to it. I'll stop talking. Oh, and we'll record this. We'll send out recordings later. The whole thing we'll put on YouTube. We'll add resources and fancy cool things and anything that we mention as we get into it. Logan, take us away.
Taking us away. All right, I'm going to go ahead and share my screen just to orient us. Thanks, everybody, for joining. This is, I think, our third, fourth, something. I don't know. We've done this a handful of times. We're losing count, so that's how many times we've done it. I think one of the things that I really love the most about these types of events too is that it's so raw, it's so real, right? These are real founders, real financial models, all of that stuff. I think that's why people really resonate with this content. So really excited to be jumping back in and doing this again. Just to set a really quick agenda. So we're going to kick things off with just a quick intro into Forecastr and myself, who's going to be one of the judges. Ryan's going to be jumping in and doing a little bit of judging this time, which is going to be a lot of fun. And then, as Ryan said, we have 3 awesome founders, potentially 3, at least 2 founders that are going to be joining us today that we're going to do a teardown with. So we're going to start with Atlantic Fish Company. Then we're going to go to Pay Bokra. I'll let Tracy kind of fill us in with what exactly her business does, and then Wish Skin Labs as well. And then we're going to end things off with a...
That's switched. Wish is Tracy's company. Yep.
Okay. We've been doing some live tweaking right here in the waiting room. So you're kind of like doing it live here with us a little bit. So in true form, these events are just kind of live and real. So it's hard to say exactly how much time we're going to have for Q&A, but we're going to do our best to have at least 10 to 15 minutes of Q&A. So in the spirit of that, we're going to jump right into it. I want to kick things off by talking a little bit about Forecastr, who we are, why we exist. The main way that I like to convey the value of Forecastr is by looking at larger companies, kind of middle market, maybe publicly traded companies, and looking at the organizational structure of these companies. So if you look at larger, more established companies, you're going to see that all of them have an organizational structure with one department in common, and that's called FP&A, and that stands for Financial Planning and Analysis. Now, the entire purpose of this business unit is to ingest financial data and non-financial data, analyze that data, project that data into the future, and make really important decisions based off of what that data is saying. If you're a smaller company, like a startup or a small to medium-sized business, you don't have the money to go out and hire a CFO or a team of analysts to build a 60-tab spreadsheet and get these types of insights. And that's why we created Forecastr. So Forecastr is a software that's built specifically to help you get these types of insights. So it's going to take all of your financial and non-financial data. It's going to put it together in a financial model, kind of like what we're going to be reviewing today. And it's going to help you make really important business decisions like, should I raise money? Who can I hire? What is my bank account going to look like in 12 months? All of those really interesting things that are going to help us run our businesses better. Forecastr helps you do out of the box. And we pair everybody up with a financial analyst to help them get as much value as possible. So if you're interested in learning more about Forecastr, we would love to chat with you. Jimmy's going to drop a link in the chat, which is the best way to get in touch with us and learn if Forecastr is right for your business. And just a little bit about myself, just so you know, kind of what gives me the right to tear down all these financial models. I'm Logan Burchett. I'm co-founder, chief operating officer here at Forecastr. Forecastr, first and foremost, is a startup, much like the companies that we work with. So We've raised about $10 million. We're a team of 32. We've got just around 700 clients actively using our software today, but we are a startup. And that's really why I love working with other startup founders, learning from other startup founders, and also kind of sharing the things that I've learned along my journey with building Forecastr. Before that, I was a fractional CFO for a number of years. I'm an Excel junkie, built 200 financial models, used Excel so much that I decided to build an app to replace it for financial modeling. Just I got tired of using it after several years. I was also on the other side of the table as an investor, as a fractional VC analyst, and I helped manage Kentucky's pension fund, which is around $16 billion in assets. But that's enough about me, enough about Forecastr for now anyway. I do want to get things kicked off with our first founder, Doug, who is going to tell us a little bit about his company. So just to set a quick agenda, and we're gonna kind of run through this with each founder. We're gonna do a 5-minute kind of pitch on your business. It's not really a pitch. It's more of just tell us about where you are, what you do, what the company does, all that. Just give us a little bit of information just to ground us in the model that we're about to see. Then we're going to go into 5 minutes of Doug, you walking us through your financial model. And then we're going to turn over to me and Ryan for 5 minutes of a financial model review. And then we're going to rinse and repeat that for each founder. All right. So without further ado, Doug, if you're ready, take us away.
Awesome. Well, thank you guys. Very excited to be here to do this. I've seen you guys do this with a few other folks, so good to be in the hot seat. I see my tabs coming through. Great. Okay, so as you said, my name is Doug Grant. I'm the co-founder and CEO of Atlantic Fish Co. So we are using cellular agriculture to make cultivated seafood. So this is real seafood. This is not a plant-based replica. It's taking the cells from an animal through a little biopsy, growing those cells up, putting them in a large bioreactor. So think about like a fermentation tank, and making real seafood. So I want to give you a few slides, just to give an overview that's relevant for the financial model. So first and foremost, this is like a deep tech R&D type company. So anybody that's doing biotech or anything that's very front loaded, for us, again, cell line development, you've got to have some sort of growth media to grow those cells in. You need to be able to grow those cells on some sort of a scaffolding, and then again, bioprocess, scale up, large bioreactors. So think big metal, so a lot of expense associated with that. With the product roadmap, what we're making, you'll see two terms in the financial model. I'll talk about hybrid products. Hybrid means that it's part plant-based and part actually real cell-based. So some ratio there, which is a real cost driver in the model with their earlier products. And also unstructured. So unstructured, think of like chicken nuggets, hamburger, fish nuggets. And then when you think of a structured product, you're thinking of something like a whole fillet. So something with flakes, something that you would, be able to like throw on the grill. So those are the two products we'll talk about, and there's different costs associated with those. A little bit about this is a relatively new technology. It's only been around for 10 years. We are still pre-seed stage. We raised $500,000, so very early. Where we want to do is get this down to $11 per pound from a COGS perspective. And then we sell our fish products to restaurants, which are currently paying $20 per pound. So just kind of anchor with those two numbers. So these others are just what's published in the literature about where the technology is industry-wide. And yeah, and then the last thing, I'll talk about pilot plants. So think about small scale. So this is why there's a lot of cost on CapEx with this. And then later on getting up to a production scale plant. So small plant, large plant. And I think that is it. And we can dive into the financial model.
Awesome. Thank you so much, Doug. I'm going to take the screen back and then we can go that. So continue. Let me go in here, share. Okay, very cool. So we got your model loaded up. And Doug, if you don't mind, I'm going to drive here and you just let me know where you want to go. And we're going to spend about 5 minutes going through this model.
Perfect. Okay, so this is just our intro tab, start here. So describes the other tabs that we've got. So the first, the tab after this describes the current burn. So this is basically our accounting, keeping track of what we're doing, our burn rate, what our expected burn rate was, and then the difference with there. So if you scroll down, you can see all these numbers add up down here at the bottom, right? So actual burn rate, projected burn, the difference, and then cash remaining. So pretty straightforward there. And again, I just use a Google Sheet and manually update this myself. If you go to the next tab, which is pre-seed, so this is our projected expenses through the end of 2024, which we're calling our pre-seed round. We've been structuring this as safes, so we're still raising on this round. But I've got the big buckets of cost, and they roll into what that projected burn rate is. So facilities, think about that as lab space, personnel, pretty obvious there. Science ops monthly, that's just expenses that we have in our lab. If you'll scroll down. Business service, business operations. Yeah, so just like big expense buckets that we have. So we have a good sense of what all of these things cost and where we are there. If you go to the seed round, which is the next one, this continues us through 2 more years. You see that we build out the team a little bit more personnel, moving into a larger lab space, but relatively the same structure as the pre-seed round in terms of projecting what the costs are going to be. And then where it gets a little, we have to make some jumps and a lot of assumptions is when we get into the next tab, which is the A and B round. So this gets into that phase where I talked about the pilot plant and the production plant. And like, truth be known, like we haven't modeled that out yet at all. So our approach with this was to look at other companies in our space and see, okay, how much did they raise for their A rounds and their B rounds? And then what size plants did they build? So that's this data here. And then if you scroll down a little bit farther, yeah, so this is our use of funds assumption. So we said, okay, if these are the average A rounds and the average B rounds, let's assume 50% in cell B56. How much of that round would have to go towards building that plant? Let's say 50%. So that was just our starting point with that. And then how much is going to have to go towards R&D? I've got 33% here. How much is going towards G of A? And trying to use those to sort of back into what we think these other companies have done when they've been at these stages farther ahead than us. So as we mature, we'll get better with this, but then this all rolls into the actual financial model that we have on the next tab. Okay, so here we are. So this goes out for 6 years through 2029, and you'll see I've got both the pilot plant modeled in year 3 and 4 in 2026 and 2027, and then we scale up to the production plant. So variables here are, how big are your bioreactors that you're making the cells? How many cells are you making? What are the COGS on those cells? Those change each year, year 3, year 4, year 5, year 6. Those are all variables. And then are you making an unstructured product or are you making a structured product? And then what percent of that product is actually cells? So in this example, if you go over to cell B19, you'll see I'm saying, okay, our first unstructured hybrid product is going to be 20% cell mass. So that allows us to make 14,237 pounds of cells and 71,185 pounds of product, because it's a 5x more product because 20% is coming from the cell mass, 80% is coming from the plant-based. And let's see, what else have I got on here that I can speak to? Sales and marketing obviously doesn't kick in on row 8 until we actually, start selling products. I've got that modeled in. And yeah, that's me trying to cover this in 5 minutes.
Yeah,
So,
no, that's good, man.
Yeah, fire away.
All right, well, good stuff. Yeah. I'm happy to kick it off, and Ryan, you feel free to like chime in if you've got anything else. So a couple of things right off the bat that I'm noticing here. So I really like the look and the feel of this model. So, one of the things, a financial model really serves 2 main purposes. It helps you make good business decisions and using math and logic to kind of like inform what you should do with your business. but it's also a fundraising tool, right? So it's also something that you use to communicate with investors. So having things organized, having things look visually appealing is important when it comes to a financial model, just like a pitch deck, right? So I think that this is laid out really well. I'm really liking even just the how to use this financial model. I like the branding. I like the coloring, all of that stuff. I think it looks really, really good. The other thing that I really like about this, Doug, is that you're actually using this model operationally. So, I was really happy to hear that you're going in and you're doing a forecast versus actual. You're saying this was the budget, this is what we actually did, this is the difference. How does that inform, business strategy and things like that? I think that that's super, super important. Otherwise, it's kind of like, what's the point, right? So you're actually using this, which I really, really like. I have mixed feelings about the pre-seed, seed, series A and B kind of breakup there. I think on the one hand, it's very useful to understand that, you're kind of compartmentalizing the different milestones that you're shooting for. So you're saying, okay, during this phase of the business, this is what we need. Then we need this, then we need that. So there's an element of that I think I actually really like, and I haven't frankly seen that before. But on the other hand, I do think it becomes a little bit confusing. It's hard to follow, like in the A and B. I'm like, what's carrying over from the seed? What is, brand new? Like, yeah, like these are some questions just that I had. So take that for what it's worth. I'm lukewarm on it. There are elements of it I like. There are elements of it I don't like. One thing I really like though are the assumption comments here. I think that that's super helpful just to kind of give a little bit of color behind the different things that you're thinking about doing. Going a little bit more into strategy on this one, and less about financial modeling, but it kind of overlaps. I would push back on the approach of just saying, what did competitors raise? And we're going to raise something in the same realm of those. And then we're going to use the amount raised and back in to how much we want to spend on different things. I think the tail's wagging the dog on that a little bit. I think what you should do instead is just take an honest look and say, for this business that we're running, what do we need to spend money on, regardless of the market? Like, just what do we need to hit our goals, right? And then use that to inform how much you should raise. And if it's way outside of market, then deal with that whenever you get to that point. But I would recommend that instead of just saying like we want X% of how much we raise, that's going to be our budget. I would go the other way. I would say, let's determine our budget. Let's let that inform how much we want to raise. And for the record, if you're pre-seed right now, I also like this part of it doesn't have to be perfect yet. Like just like get something that's kind of directional and just be like, all right, we're good with it, and kind of like run it like that. But I definitely wouldn't do the percentage based off you raise. And then last thing I'll say before I kick it over to Ryan, is that, this is a really, really good summary. I would love to see this monthly, not just annual. It makes it a lot easier to kind of continue to operationalize. But then the other thing that I don't know if this is an error, but if it's not, then it's something I would definitely want to understand more, is why you go from like minus $7 million in net income to minus 43 million back up to positive 12. And I see that it's because this is $53 million in year 5 compared to $5.3 million in year 6. I suspect there might accidentally be an extra zero here, but I'm not actually sure. So if that is an error, then we just need to fix it.
It's real. That's
real.
So
okay.
that's the production plant build out. And
understood.
At one point I had this straddling over 2 years, and then just to simplify it, I went ahead and put it in 1 year.
Yep.
And it is real that usually 10% cost annual maintenance on that facility. So you build the facility in year 5, and then 10% of that cost in year 6 to maintain it.
Okay. One recommendation.
In reality, that's probably not. Yeah, that cost would probably expand across a couple years.
Understood. So that really doesn't belong on the income statement. That belongs on the balance sheet. We can get into the minutia of that if you want to just like email me or something. But basically, the short version is, when you're doing a big build out like that, that's an asset that the business is going to own. So you want to put that as an asset on the balance sheet. That's called capitalizing an expense. And then you're going to depreciate that expense over a long period of time. When you do that, your income statement doesn't look lumpy like this, which is a good thing. Yep. Ryan, I'll kick it over to you. Sorry, I feel like I stole the easy, obvious one. So maybe I'll
Well,
let you next time.
and I get to no, you're going first next time. You're the expert here.
Okay.
I'm going to build off of the well, let me get to that first. The first thing is I love the various resolutions of how much thought you've put into this for the stage of the business. So, and I think Logan kind of nailed it. It's like, and you sort of hand waved like the series A and B haven't really been filled out. I kind of feel like they're perfectly filled out for where you're at. Because if you spent more time modeling this, 3-year future or something like that, and less time actually just working on the business at the stage it is, it's like, yeah, you're making up stuff for whatever. But I think it's kind of nice that the tabs actually kind of tell a time ordered story, but the resolution gets blurrier as they go on. So just like with the forecasting software development, I often refer to the headlight model, which is the things at night that while you're driving, the signs that are closer are in higher resolution. And like, that's good. That's showing you that like, you're not spending way too much time on stuff that doesn't even matter. And, really focusing on like that, live point between the actuals and, what's the most important next milestone. I think a lot of the information that you've put in there, like Logan said, would be really great for pitching. Like, I think this is, there's definite improvements to make, but this is a great model to collaborate over. It might show a little naivete with what Logan just pointed out with the yearly breakdown on an income statement or whatnot. But even there's a lot to work with, and there's a lot of assumptions in there that you can, kind of spar with potential investors and advisor about. So it's a useful model. It's a living model for a lot of reasons. I think it's so close to being what I would think of as like, I like the round based breakdowns, but I think they should be kind of like pushed further from tabs 3 and 4. And instead, if you took that actuals by the month tab and you had those actuals span the next 5 years of monthly, and then the data that you've put into the round things can influence the monthly like growth or shrinkage of various expenses and revenues, that builds you a narrative that you can start at the high level. And then when you talk about like, hey, we need a bunch of cash to build a massive facility, like that's where the narrative in the model really works really well. Like I think Logan showed in the past, if you've been to a couple of these, it's like, startups that raise money are growing bankrupt, with their financials, but that's where the cash infusions makes a lot of sense. And I think there's a real psychological impact when you see the right numbers going up, but the cash running out, but the velocity being built, and it's not in one tab where it's like seed. And it's like really hard to connect like how seed connected to pre-seed and whatnot if you're looking at isolation. But I think you could use the data that you put into those to influence kind of a monthly perspective narrative. That would be a really powerful storytelling tool, and also something that you could sit down. I don't know if you have a team. It sounds like you have a team. You're in a lab and things like that. But on a monthly basis, and be like, hey, how are things actually tracking out? Do we need to tweak things? Do we need to accelerate this fundraising round? Can we defer it? Best thing in the world, etc. And let me think of my other notes that I was putting in here. Just in terms of, I do like the stylistic approach in terms of Excel things, but I think the clarity in my brain, there's an Excel model of like bright blue things are things that can change in their assumption, black things are things that are calculated, and like actuals are filled in with a different treatment. Somewhere in there, nothing is speaking to me directly when I look at these as if like that's the common thing. It's just like I have to interpret, somebody has to explain to me what these color means. Like, why is there, different color backgrounds and stuff. I think there are rote standards for that kind of stuff that like allows, people who are consuming it to say like, oh, this is fiddleable. Oh, this is calculated, etc.
Yeah, I agree with all that, Ryan. Last thing I'll say before we give Tracy the floor is that I think if you're a pre-seed stage company, Doug, and if we're focusing on using this model for fundraising, I think you're pretty much there. I think that this is a good model. It's going to get you what you need from a fundraising perspective. From an operational perspective, like trying to like get really dialed in and like make it a useful kind of like tool to run the business better. I think that there's some improvements that can be made, but I think if what you're looking for is to like get this in front of investors, I think that you're in a great spot, man. I think that this is one of the better models that I've seen at your stage. So kudos to you on that. I think it's a really good first starter model for where you're at. I think that this is exactly what it needs to be.
All right, before we jump over to Tracy, we have 2 questions. Sorry, Doug, I'll let you do a finish up real quick. I just want to get these because they're super relevant questions. Nicholas Mears asks, based on Logan, your feedback about the Series A, Series B, basing them off honest expectations rather than what other people have used the money for. If you're pre-seed and still finalizing the product, like, is there a different approach? Should it be any higher resolution? Like, should it have just been we'll get there?
It's a tricky, yeah. So modeling is a bit of an art and a bit of a science, and so it's one of those things like what you said, Ryan. It's like visibility in the near term is very, very clear. If you're at pre-seed and you're trying to figure out what you're going to need for a Series A, that's kind of a tricky thing to understand. But generally, I mean, like whenever Forecastr did it, whenever we were at pre-seed and we were forecasting our Series A, we just sat down as a team and we just said, look, we're a software company. At the Series A, we'd want 10 to 15 developers. We need a sales staff. We need this. We need, like, that's the level of granularity that we go into. It's very much get a whiteboard out and just get your team together and just talk and you're like, yeah, that seems about what we would need for a Series A. And like that's literally the level of detail that we like to go into whenever you're this early. As you get closer and closer and closer, that level of visibility is going to get more and more crisp and more clear until by the time you're actually raising a Series A, you're going to have a really strong understanding of what your costs need to look like. But I think it is important just to be able to do it from a bottoms up perspective like that, because at the end of the day, you're going to want to be able to look at that and see these are the positions that we have. These are, all of the things that we're going to be spending money on, et cetera, et cetera. And it gives you more weight whenever you finally go out to raise that round too, because it's not just we saw somebody else raise this amount, so we're going to do something similar, and this is what we're going to spend that money on. It's a position of strength that we really thought about this. This is what we need, and because of that, we're raising this much. It's kind of it's a nuanced but different thing. So,
yeah, you can make a deal. You can make a funding round a better deal for investors to maybe close it quicker, or justify a much higher raise based on fundamentals that don't just have to price to market. One last quick question from David, and we'll move on to you, Tracy. David asks about Doug's model. How do you calculate COGS? COGS is cost of goods sold. So in any kind of product that has like a basic set of components necessary to deliver the service. So like for Gust Launch, we have to file things in Delaware and we have to keep up to date. So we can calculate, how much revenue we make out of a subscription to how much we have to pay. I assume for a lab, it's even more direct like that. You're literally producing physical products. So you have to figure out how much that costs you and what's the margin. So that's what cost of goods sold is. But David asks, are you just assuming a projected margin? Is it okay to just assume a margin and go with it? Or do you need more detail? So I guess one to Doug, how did you account for COGS? And then we can float it up for like,
so like I said, we're at the bench scale right now. So we looked at what's in the published literature about this. So we know 11 pounds is what is possible. Other people have said it, and it's something that we can anchor to, that investors will say, okay, yeah, I know that's real. And then we also have done our own research to know what people are paying, our customers are paying for these types of fish. So and then everything else is just sort of those other numbers I have leading to that are just kind of picked out of the air, to show a downward.
And I think that's great. When you're in pre-seed, it's like, get some good research on COGS, look at the market, do the things, but don't sweat it too hard, if you really need to get something in there.
Totally agree. And then just to touch on what should you do type of deal, depends on the business. If you're a software business that you're like, it's mainly going to be hosting costs and maybe some payment processing fees, and you have a good sense of what that percentage is going to be, by all means, just throw in a percentage margin and go up like that. If you're someone like Forecastr that has financial analysts that need to be hired at specific points, so we want to attribute a piece of their cost, to cost of goods sold, then it can be a little bit more nuanced. So it really just depends. And it's, probably more than we can get into in the time allotted, but I'll leave it at, it depends on your business. Some that's fine. Some it's not fun.
Cool. Excellent.
All right.
We got some general questions we'll push to the end, but Tracy, thank you so much, Doug.
Thank you, Doug. Much appreciated. We are moving on to, we're going to have to skip Muhammad. All right. So we're going to go straight to you, Tracy. So reminder, 5 minutes of what it is that you all do, and then we're going to get into the model, and then we'll get some feedback.
Okay. And you going to give me chance to share screen, or?
If you'd like. Yeah, go ahead. I don't know how you did it, Doug, but it just kind of got taken over.
It just kind of taken over. Yeah. Let me see. I'll say,
yeah. Share screen. I had, yeah.
Yeah, let me.
Yeah, you all should have access enough. Let me know if I need to tinker with hosting.
Yeah, it'll just say, are you sure? Yep, there you go. You got it.
Yeah, so let's pull this up. So thank you. I'm presenting Wishkin Labs. We are a pre-seed, actually pre-revenue biotech company. We're actually two businesses. One is a sales, marketing, and branding company, and that's and then we're creating IP and formulating these topical brands out of hemp derivatives. Predominantly CBD, CBG, CBC isolates, making wound care topicals. And so problem is basically what I just said. Wounds, chronic wounds are essentially a silent epidemic in the entire world. This was actually an MBA project of mine that I'm launching, but ultimately we're harnessing the benefits of the entourage effect with these isolates to treat patients. And specifically our first several SKUs are actually still in production, which is why we're pre-revenue and haven't sold anything. But we do have a financial model, which is what was submitted and will be presented here. And so the solution ultimately are, and the one that I think we'll just kind of focus on is our Emerald Wound Care first SKU, which is a diaper rash cream that has CBD derivatives inside of it. So I think that probably touches on the introduction. If you want to go ahead and pull up the model. And sure. We can go through that. You actually were given two spreadsheets. One is the general financial model, and then the second one is more of a nuanced model that's specific to Emerald's pilots and launch if we once we begin to sell our first commercial batches.
Cool.
So
if you want, I see that you have the model up there. I'm happy to present and share my screen, or if you want to just go through it, that's totally fine too.
Yeah, sure, we can do it that way. So I think I'm going to go ahead and just talk about, this was, again, modeled when we are ready to basically start to commercially scale. And I think we'll start with, I think since we started talking about COGS. So in our model, we have several tabs here, and this is our COGS tabs. Emerald Wound Care is going to be skewed in two lots. One is a 30 count box and the other is a 60 count box. And this model goes, I think it's a 6-year model that was created. So, and our COGS are based on turnkey cost. And so our manufacturer just gets us a unit price for each of the SKUs that we purchase. And we're purchasing batches in 1,000 units. So those come as basically flats or pallets into our fulfillment center, and then through our either B2B channel or our D2C channels and sales will be ordered based on unit number, order cart value. And so within our COGS, we've just accounted for those individual SKU unit prices. Of course, shipping costs and payment processing are listed here as well. Let's see. Going to our projections tab, we have listed basics, revenue, and enabled. We initially thought we were going to launch back in May of 2023, but we had an issue with our production, so we are still in delay. But as you can see, we have it modeled basically on each one of the SKUs. Cutaneous is a third SKU that's still in prototyping, and we're basically using this pretty much for fundraising, just to kind of go off of what's been discussed in the previous. So we've been using this to just sort of to produce some projections and make some assumptions on what the ultimate projected annual run rate would be, and total available market, which I'll go to that second spreadsheet in just a minute for Emerald. But we're essentially reverse engineering or target costing our products and our price. And so that's how we've essentially come up with the average price per unit, and then making assumptions what our average order cost would be to determine what our product margin and cost and COGS would be once those orders and sales have occurred. So with regards to our SG&A expenses and some more direct operating costs, we have this tab listed here with all of our payroll which is predominantly executive director sales and executive team. And then of course, we have space for, but not yet, I guess, numbers for our sales and marketing teams, which would only make sense when we're ready to actually start going out there and hitting the payment. So, so this actually feeds into ultimately the projections tab, which I'm sorry is team and salaries tab here, which shows our operating cost for talent in G&A. So, and then for our fundraising, and we had talked about our needs, what are right now in our pre-sale, pre-revenue phase, our burn rate's at right around $10,000. And so we had just projected that this raise would be for the next 24 months. So we were looking for $250,000. We have a very small number of investors right now, which is basically me, my co-founder sister, and one of our formulation scientists. So, but this is essentially to get us to basic launch, and it's paying mostly for intellectual property protection at this point. What we're using and looking for the funds for. And then branding and getting at least one or two talented sales members to join the company to get out there and start with the B2B sales. And that's going to be our first strategy when we actually get Emerald ready to launch, because Americans that have incontinence is the target customer segment in which we're selling to, and most of those that are at risk for incontinence and skin breakdown, which is what Emerald Wound Care is used for, do live and reside in nursing and skilled nursing facilities. And so this spreadsheet actually gives a really bird's eye view, but just basically what the total and serviceable available markets are. Total available markets in the U.S. In 2021 had 1.3 million daily users of incontinent cream of some variety, and therefore, based on our pricing, which we have again reverse engineered based on competitive analysis and competitive intel research, that we would be selling our 30-unit box price at $138 a box, which is essentially 14-day supply, because you're using the sachets, you're using those twice a day. And so, but we comb this also down into the serviceable available market here in Denver, Colorado, which is where I live, and then expanding over the years 2, 3, and 4 into other states, simply because we are a CBD product, and a lot of the sales is going to be dependent on financial risk in terms of transactions and purchasing CBD products, and also state regulations. So we decided that we would target and stay within Colorado, and then slowly expand out to the other states that have deregulated the sale of CBD. And we are a THC-free brand, so we don't have too much to worry about in terms of marijuana regulations, and we don't have any operating expenses related to like regulatory licensing and all of that go into if you actually sell THC products. So, so yeah, I think that probably is a good summary of our model, and thank you for letting me present, and we open to your feedback.
Love it. Great job, Tracy. Will you do me a quick favor and go to the original financial model and just go to the annual income statement really quick, just so we get a quick sense of that. FS annual.
FS annual. Yep. Thank you.
No problem. Okay. And then we're showing revenue. Okay. Very cool. Very cool. All right. Well, I'm happy to go first and give you a little bit of feedback from my end. So very similar to Doug, I would say, at the front end, I really love the way that this model looks, and like I said, it's a fundraising instrument. It's something that's really, really helpful whenever it comes to fundraising. I think it looks great. It's designed great. I believe this is probably one.
We lost sound, Logan.
Yeah. Oh, Jesus. I was checking my own stuff for that one. Logan, we can't hear you.
Dang it. Can you hear me now?
Yeah.
Yeah, there we go.
I don't know what just happened. I think my computer accidentally connected to my AirPods. Either way, I think it looks really good. I think it's formatted really, really well, and I think that it tells a really, really good story. I think I like the way that it's bottoms up. I like the way that you've got individual team members that you're going to be hiring. I like that you have specific dates for that. It's very clear to me and understand like kind of what the future is going to look like for the company based off of this. So I think all of that is really, really strong. Just to give you a little bit of not even necessarily critiques, just some things to watch out for. If I'm looking at this annual income statement, I'm seeing a company that I wouldn't classify as venture fundable based off of these numbers. Not to say that your company is not venture fundable, but based off the numbers that we're looking at right now, I think it'd be tough to get venture funding simply because we're growing to about 3.2 million in annual revenue. Now, there's nothing wrong with that at all. Like if you're like, I want to have more of a lifestyle business that's generating good, strong cash flow and giving like the relevant stakeholders, a decent chunk of change, there's nothing wrong with that. But it is something to be aware of that if you're trying to kind of march down that we're going to be a massive company, we're going to grow this thing and be huge, then you're going to want to bump these numbers up pretty significantly. If you're like, hey, I just want some good angels to come and help me grow a nice lifestyle brand, then this model is completely fine, but it's just something to be aware of, right?
Yep.
One thing that I'll say. The other thing that I'll say, and I know Ryan was probably going to go at this as well. I did notice a valuation tab in this model, which is so completely fine that they have something that's kind of like helping you understand what the future value of the company can be. One point of caution that I'll give you is I wouldn't rely too much on that when it comes to fundraising. A lot of fundraising is just going to be negotiations. It's going to be you finding an investor and then kind of negotiating what you think the company is worth, what they're willing to invest at what valuation, things like that. It's not determined by a backstop of mathematical calculations, especially whenever you're pre-revenue. That's just not how these deals are done. So just a word of caution on that is I wouldn't lean too heavily on that valuation. I'll also note that I did notice that in that tab, it said that the investor would be getting around 5% of the company, which is off market for what traditional kind of pre-seed rounds are. Usually those are between probably 15 and 25%. So just something to be aware of, right? So that's just something that I'll say. Other than that, though, I would say very similar to Doug, you're in a really good spot with this model with where you are pre-revenue. I think this is pretty much what you need. You need something that looks good. You need something that tells the story that you want to tell, something that's easy to navigate, something that you can use to run your business after the fundraise. And that would be my final point before I turn it over to Ryan. I would just say, you said you're using this for fundraising, which is great. That's one of the things that models are for. I would say once that fundraise is over, just don't lose this model. Like go in, update it, make sure that you're using it to make good business decisions and make sure that you don't run out of cash. But generally, I think this is really good. I think it's a really good model. Ryan, what do you think?
Yeah, let me highlight different things so I don't just repeat Logan. One thing I really like to see was, and this is something that you can definitely pull off in G Sheets more and more now, but it looked like you had some scenario-based planning. Like you could configure like when we go live. So like, what does our model look like when we go live in May? Oh, May didn't happen. So what does it look like when it's in June? What about October? And that is really powerful way. Yeah. So I've seen a lot of people do scenario modeling, and I am guilty of this as well, is taking a spreadsheet somebody else in the company built, making a copy of it and changing everything rather than building it into the model itself so that you could actually like toggle some things. I think honestly that is a problem that Forecastr was probably created specifically for, is because Excel sheets are very error prone when you do that, but you can get it done if you have the, you know, the attention to detail and you get your formulas right. It's a really powerful way to not just have a model that says what you hope would happen and then what is happening, but one that you can say, well, what would happen if blank and blank? So that's a really cool thing to see. I felt like I love that you had the COGS breakdown as much as you did. And I think leading with, when explaining your model, starting with the COGS, it took me a while to grasp how complete this model really was. So I think where Logan, I imagine Logan shared a little bit of this, because where he way found to near the end was that top level thing, which I think was FS month and FS annual. That's generally what anybody who's consuming a financial model wants to start with, because that's basically like, here is where the company is going if things work out well. You know, start with the years, and that if you're talking with investors, that tells you what kind of investor you're talking with. You know, VCs, like you said, won't do this, but if there's other product lines that are coming in 2026 and 2027, and this is more than just Emerald, you know, and the whole company is based on the ideas that we're going to produce a ton of product lines and we're going to have revenues of this. And then monthly is like, okay, you know, first is like, yes, this is in my wheelhouse. You know, this is a company I invest in that has a growth potential of whatever I'm looking for, or even a return potential, revenue base, who knows? But then the monthly really starts to say, okay, like, what does this story actually look like? And what assumptions are they making as time goes on, rather than just like up and to the right? And then you can break it down into like, I think the rest of it is like, how do I believe what I saw in those things? And that's where COGS come into play. That's where staffing comes into play. That's where you can really like, you know, kind of tighten the bolts on, does this top level thing that excited me actually go ground up, make sense? The staffing tab is great. Like, I think that's one of the biggest overlooked things people do with financial models, is they don't account for staffing with the granularity that you did. And that also, again, to Doug, the point I gave Doug, is like putting the things that you can fiddle with in there, so that when you're having conversations both internally and possibly with investors and advisors, if somebody says, I think you'll need a sales force twice that big, I think you'll need to hire this role before that role, or something like that, you can actually simulate that both for yourselves and for the funding round. But it's awesome to have that stuff in there. I had to take notes. Nice raise coverage. Raising for 24 months, I think, shows, you know, a reasonable amount of intuition and common sense. Not like, oh, we're going to raise funds every 12 months. You know, it's like, no, it's like you're giving yourself a decent amount of runway. I had a hard time, and Logan might tell me I'm wrong, parsing the total addressable market sheet. It was honestly, for me, just like all the content being kind of on the right in the big space. Like I wasn't really sure what I was gravitating towards, and what was date oriented, what was assumption based. It just wasn't a format that I have seen before. So it took you a lot of explaining before I could kind of see where some of this stuff is, but I'm still a little vague on it right now. But I do think the one thing I plucked out of this page that was positive is the local market, total addressable market, and the acknowledgement of what sounds like a distribution and go-to-market strategy that is not naive, in terms of like, I think a lot of times, especially on edge regulation companies, a lot of founders, you know, basically say, well, this is inevitable. You know, every state is going to legalize, you know, marijuana use eventually. Therefore, I'm capitalizing on this opportunity, to differentiate yourself from people who assume that, you know, AI is going to run all of our jobs, or, you know, everybody's going to buy NFTs, is actually breaking it down to be like, how am I going to actually go to market in this, knowing that a delay in regulation could be 3 years worth of an unpenetrable market or something like that. Seeing that in the model is actually kind of cool for me, because it shows an extra level of thoroughness or thoughtfulness in plotting this out, and that you're not just, there's a fine line between the crazy entrepreneur and the delusional entrepreneur, and we all have to be a little crazy, but we have to avoid falling into the delusion. And I think that's all. That's my notes.
That's awesome. Well, I think that's
thank you.
Great work, Tracy. Great work to both of our founders today. And I think it's probably a good thing that we only had two, because we're right here at time. So, you know, I know that we've got a few questions in the chat. I'm going to really quickly wrap up my stuff on here just by offering a 20% discount to anybody that wants to join Forecastr. Just give you a sense of what our packages look like. These are the undiscounted prices, so you can take 20% off of this if you're interested. So Forecastr model, we have 3 plans: the Essentials plan, Growth plan, all the way up to CFO plan. Essentials plan is going to be a Forecastr account where we pair you up with an analyst. They're going to build your model for you. They're going to keep that model updated on a quarterly basis and give you custom reporting for that model. The growth plan is the same deal, but we do it on a monthly basis and give investor reporting and just kind of operational reporting all the way up to CFO services, which is where we pair you up with the CFO. And just give you a quick peek behind the curtain. This is Forecastr's financial model. So you can see that we have all the bells and whistles. We have the 3 statements monthly, annually, and we can actually link up your accounting to show you variances, actuals, all of that good stuff, as well as all of the assumptions that back all of that up. And we can get very granular and very, very detailed. But rather than go through more of that, I do want to open it up for questions because we've got 5 minutes left. So Ryan, what we got?
All right, real quick. I think Jimmy, by the way, thank you very much for handling the chat and throwing some links out there. Dana asks for you, Logan. He's been to a couple of these, it sounds like, and very helpful to see, but do you have high-level financial modeling advice or even financial model structure for a services-based industry rather than kind of CPG, direct to consumer, more traditional startup-y companies?
Great question. So I'll go kind of like high level, and then I'll kind of maybe zoom in on services a little bit. So from a high level, you just every type of business is kind of like subtly different in a variety of different ways. So what you want to do is you want to think through the entire life cycle of how revenue comes in the door for you and work backwards from there, right? So how are you getting the customers is a good way to start. Are you reaching out to them? Is it more of a sales process? Is it paid ads? Is it hosting webinars, whatever that is, however you're getting customers in the door, start with that. And then once you get them, how do you monetize them? What does that look like? Is it a subscription? All of that stuff. So if I'm looking at maybe a services company that does monthly consultations, so like the one that I'm most familiar with is fractional CFO services, because that's what Forecastr offers. So for fractional CFO services, it's a monthly engagement, right? We charge anywhere from $1,500 up to $4,500 per month, depending on what you need. So if I'm looking at how we get fractional CFO service clients, I'll use maybe a direct sales example. We might have an SDR that goes and emails 1,000 people a month. We get them onto a call with an AE, and then we close that deal, right? So if I were to model that, I would say one person is emailing of those people, of those 1,000, how many people do we get onto a demo call? Of those demos, how many do we close down to customers? Those customers then go into a subscription, and then it kind of like is a SaaS kind of model from there in a sense. So it's all about just working your way through the funnel, coming up with all the different assumptions and going from that. But it all starts with how you're generating revenue, whether it's an hourly rate, whether it's monthly rates, all of that stuff, and working backwards from there. And if I'm not mistaken, Jimmy, I think we might have a template for services-based companies on Forecastr's website. So maybe just go to, forecastr.com/templates. Jimmy's going to share a link right now. And that should give you some direction on what you need. Or just meet with somebody from the Forecastr team through the demo request, and they'll point you in the right direction as well.
And I think Tracy messaged me on the side. She has a financial model for a services-based medical company. So we get this question at least once a thing. So maybe we'll do like a themed teardown someday where we actually bring out some of those business models that people just have a hard time wrapping their heads around when we talk about subscriptions or facilities and things like that. And they're like, what if mine's that? So that's an idea for future programming, Logan.
Big time. Yep, totally agree.
All right. I think that got most of the pressing questions, and I know we have a hard stop at 4, so I just want to take a time to say, Doug, Tracy, thank you so much. Tracy, especially for dealing with my Labor Day last minute invite. This was great. This was one of my favorite ones. Solid models. Like I said, we'll send out a recording to this in a couple days. We'll put some of the links to the things we mentioned, the templates, the discounts, and things like that. Be sure you use the right links so that we can honor you, but we usually figure out where people come from. So get in touch with their team. We've heard only positive things from Gus customers who have come over and really leveled up, their financial wherewithal for their startups. Look out for more of these. We're almost hitting a monthly cadence with this. We're also doing just more abstract, higher level programming with Forecastr and other partners, kicking off a bunch of stuff for the fall and into Q4. Tons of stuff coming from me. Logan, thank you again, always for your insight and taking time. Jimmy, for helping me manage the chat and the Q&A. And again, Doug and Tracy, thank you. Have a lovely week, everybody.
Much appreciated. See y'all.